Welcome to DWS Market Update. The announcement that a majority might be found in the German Parliament for a modification of the debt brake following the general elections has led to significant price moves in markets. The German stock market reacted with further price increases, thereby continuing its outperformance against the US market. The euro appreciated against the dollar. The bond market, however, responded less enthusiastically. Stronger growth and the possibility of higher inflation rates mean that the European Central Bank is likely to cut interest rates by less than would otherwise have been the case. As a result, yields on 10-year German government bonds spiked by around 40 basis points. Looking at the relationship between different instruments in the bond market, one can derive a few interesting observations. The main contribution to the rise in yields came from real yields, as can be seen in inflation-indexed bonds. Translated from fixed income market language, this means that the market now expects higher real growth rates over the coming years. The increased yield spread between long-dated and short-dated bonds, the so-called steepness of the yield curve, is another way of the bond market to express higher growth expectations. Another significant contribution to the rise in yields came from inflation expectations, derived from the difference between nominal and real yields. A third, but only marginal contribution came from credit risk premiums, which can be derived from the pricing of credit default swaps. The bond market's overall assessment, thus, points to significantly higher growth expectations, coupled with somewhat higher inflation rates. With regards to the credit quality of the Federal Republic of Germany, however, the market remains just as relaxed as it was before the fiscal measures were announced. That's it for today. Thanks for watching and goodbye.